Hi, I'm Joshua Freedman, news editor at Rapaport, and welcome to the Rapaport Market Comment, thanks to our sponsor Rapnet. One of the unusual things about the rough diamond market is that prices don't necessarily track the current state of trading, and that's especially true with De Beers. When the market slows, De Beers has two options: reduce prices or supply. In the second half of this year, it chose the latter, allowing site holders to leave diamonds on the table without repercussions. In normal circumstances, the company penalizes customers that fail to buy their allocated goods by offering them less in future. Because of this flexibility, the company has seen its lowest sales in 3 years and has incurred a loss in the second half of this year. Last week, parent company Anglo American said it was cutting De Beers' overhead by $100 million per year. The strategy has led to a situation where De Beers goods are now some 15% higher than prices at other tenders and auctions. Prices at those tenders and auctions have fallen in line with the recent market downturn, yet De Beers' prices haven't been adjusted since July. But De Beers needs sales in order to return to profitability, so there are two ways for that to happen. One is a recovery in demand. This is possible because Indian manufacturers have been shut for 2 months from October the 15th to December the 15th, while the country observed a voluntary import freeze to manage the market oversupply. Having reopened, they hardly have any rough to work with. Wider G7 sanctions on Russian diamonds are also expected in the new year, presenting a potential lack of supply. Meanwhile, demand for polished has picked up a little ahead of the holiday season. Petra Diamonds, which owns the Cullinan and other mines, reported a 20% increase in rough prices at its December tender compared with October. The other option is to reduce prices at its next site in January. This is an option some site holders believe is likely, not because the market will worsen, but specifically because of the market improvement, which enables the company to entice buyers without flooding the market with goods. De Beers would clearly prefer the first option, being able to sell the stockpiles it's built up without having to reduce prices. Furthermore, the miner has already hinted to site holders that it could lower prices. It reduced their allocations of rough for 2024 by 10% to 20% by value compared with 2023, as we reported last week on Rapaport.com. Customers believe this reflects the price reductions De Beers made during the course of this year, as well as likely cuts next year. Given that De Beers' official rough price index declined only 2% in the first half of 2023, and we understand the company made just one price reduction in the second half, this leaves a lot of room for price drops next year. Site holders believe the miner is waiting to see how the market and the holiday season play out before making a decision ahead of the site, which begins on January the 15th. A possible compromise would be a price cut of around 5% to 10%, but one site holder I spoke to expected an even bigger reduction. Before we go, let's consider an important point. True, when the bigger miners reduce prices, that enables manufacturers to make bigger margins on the polished. But it also means their customers might start knocking on the door asking for their own discounts. And news of a price cut by the biggest miner could affect sentiment throughout the industry, even when the event that prompted a price cut was a market improvement. If you like this video, please subscribe to get every new one we make on a weekly basis, discussing trends and analysis in the diamond industry. This video is brought to you by Rapnet, the world's largest and most trusted diamond trading network. If you buy and sell diamonds, Rapnet is the right solution for you. Find out more at rapnet.com. Wishing everyone a happy and peaceful week ahead.